Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the latest news updates that investors need to know about. For more videos just like this one, don't forget to go and annihilate that like button right now, subscribe if you are new, comment down below about any or all of these stories, and with that being said, let's get right into today's video. Investors are not so happy because the Federal Reserve might not cut interest rates as soon as they originally hoped. And this has caused the stock market to downtrend, with the Nasdaq and the S&P 500 losing some value today, but overall, I would say that 2024 has been a pretty good year so far, especially for the start of a year. However, we do have Tesla in the news. Tesla is an electric vehicle manufacturer that specializes in energy storage as well as energy generation, and they also focus on artificial intelligence. They have been in the news a lot lately thanks to Elon Musk and their various artificial intelligence products, but right now we want to talk about their electric vehicles. If you've been outside recently, you know that it's pretty cold out right now, specifically over in Chicago, where the wind chill fell as low as negative 25 degrees Fahrenheit this week. The reason why the weather is relevant is because Tesla owners had a lot of trouble trying to overcome cold weather. The weather got so bad and so cold that Tesla vehicles actually stopped working, where customers had to abandon their vehicles because the car was completely useless. This is because freezing temperatures can cut the life of an electric vehicle battery and even make it completely useless, to where Tesla graveyards have now become a thing, to where you can see on social media people filming other people with Teslas or any other electric vehicle which have been stranded on the side of the road. On top of that, it makes charging electric vehicles a lot worse when the weather is very cold. Drivers reported that it has taken them hours to charge their electric vehicles. And since the electric vehicles take so long to charge, this extends the wait time for other vehicles to try to get a charging opportunity. But freezing temperatures are not the only problem for electric vehicle owners, considering that very intense heat can also cut the battery life of an electric vehicle. So this is not necessarily just a Tesla problem, but considering that they're a market leader and the majority of people who have an electric vehicle, it's most likely a Tesla, that's why Tesla is receiving bad publicity. But I think it's only a matter of time before Tesla solves this problem in future models, but in the meantime, this is something to be aware of if you're thinking about buying an electric vehicle. But it's not all bad news about Tesla, because Tesla does have plans to launch their Cybertruck on a tour of China. Essentially, Tesla plans to launch a nationwide tour over in China to show off the Cybertruck and its capabilities. Now, the timing and format of the Cybertruck tour over in China is relatively unclear, and so far, we have not seen any Cybertruck orders on their Chinese website because their Cybertruck isn't even available for purchase on the Chinese website as of right now. If you weren't familiar, China is one of the electric vehicle capitals of the entire world, and competition is heating up over there. We see Tesla compete with other electric vehicle companies such as BYD, NIO, Li Auto, XPeng, and many others. In my personal opinion, I think Tesla, ticker symbol TSLA, and BYD company, ticker symbol BYDDF or BYDDY, are the two grand winners of this space. But that's not to say that companies like Li Auto and NIO won't give you a good return on your investment. I'm just saying that the giants over there are clearly Tesla and BYD, at least for now. However, investors still need to keep in mind that the Tesla share price is down 12% in 2024. You should also know that Tesla is less than a week away from reporting their Q4 earnings results, so investors are holding their breath for this. And honestly, I think Tesla is a pretty good buying opportunity right now, considering that they're only trading at $211, which is a pretty good steal for this company. But we also have another technology company in the news that I'm a big fan of, and that is Palantir Technologies. Palantir Technologies recently received a rating upgrade from this stock reporter, and to summarize his article, he outlines 4 major points. Palantir Technologies is a leading artificial intelligence company, and they could become one of America's most influential companies over the next 10 years. Recently, Palantir's technology has been utilized on the battlefield regarding the intelligence and decision-making that this company can actually do. Their technology is so good and so stable and so safe that literally people's lives are entrusted in the software of this company. And in coming months, there's going to be more importance on artificial intelligence and military capabilities. The author goes on to argue that as geopolitical strife and turmoil increases, Palantir's share price is going to go up because their technology is essentially irreplaceable. Palantir is a critical artificial intelligence enabler in the military and for the general West and their allies. allies, and it helps them stay ahead of their foes. However, the fourth point is the one that I'm reporting on right here, and that he upgraded his sell rating to a hold rating. Slowly, we are seeing analysts and financial reporters change their mind for the positive about Palantir Technologies. Originally, this reporter had a sell rating on the company, and now he upgraded them to a hold rating, and honestly, I'm going to take that. Any good publicity that Palantir gets, I think, is a win for Palantir investors, but I would love to hear your thoughts down below. The author even said that he views $13.50 as a strong support level for Palantir. So if your average cost basis is below $13.50, then you are in a pretty good position right now. But Tesla and Palantir are not the only technology companies in the news today, because we also have Google in the news. Alphabet, who is the parent company of Google, and their ticker symbol GOOG is one of my all-time favorite investments. However, recently, Google has been laying off employees left and right. As of late, they have laid off hundreds of workers in ad sales over at YouTube. And this news came after they already laid off approximately 1,000 staffers without a really good explanation. However, we also see companies like Amazon and Discord having to cut approximately 7.5 thousand employees for the quest of quote-unquote efficiencies. Do you know why these technology companies are laying off people? It's because of artificial intelligence. AI is taking these people's jobs. We are now entering into an era where companies are laying off people because of artificial intelligence, and I would love to hear your thoughts about the ethics of this down below. Where do we draw the line for this? And is Google and Amazon right for doing this to save money, or do you think they should hire people even though robots can do their job? Despite the bad news, we also have some good news, because Analog Devices, NXP Semiconductors, and Microchip Technology were upgraded recently. Analog Devices, ticker symbol ADI, trades for $188, while Microchip Technology, ticker symbol MCHP, trades at $85, and NXPI, which is NXP Semiconductors, trades for $210. And after this upgrade by Wolf Research, we see all of their share prices increasing, and that is very good news. Now, I personally own Analog Devices in my portfolio, ticker symbol ADI, and they have a buy rating among Seeking Alpha authors, and they have the majority of analysts saying buy on their stock. So I would highly recommend you look further into that company, or honestly any of these three companies, because this upgrade is well warranted. But those companies aren't the only companies that are making major moves today. For instance, let's start off talking about Taiwan Semiconductor, ticker symbol TSM. The company saw a 4% increase in their share price because the company expects a robust revenue growth rate of at least 8%, which is very positive. We also saw the car rental company Hertz Global Holdings, ticker symbol HTZ, also increase in their share price. The reason for the surge of 6% in their share price was due to an upgrade by Morgan Stanley from equal weight to overweight, which is very positive news. So it's great news to see upgrades in regards to both of these stocks. However, there are some big losers today. Let's start off talking about Discover Financial Services. Ticker symbol DFS has plunged more than 10% in response to less than impressive Q4 results. The reason why they plunged in their share price was due to a substantial 62% decline in their Q4 profit. We also see companies like Plug Power, ticker symbol PLUG, ticker name Plug, falling by 15%, despite them falling by 10% the previous trading session. So honestly, this does not look good for Plug Power, so later in the video, I'm going to give you 3 companies to look out for that, in my opinion, could be better than Plug Power in regards to hydrogen fuel cell or even hydrogen technology in general. We also see Humana, ticker symbol HUM, ticker name HUM, and their share price fell by 14% after the health insurance provider revised its annual profit outlook due to then, quote, higher than expected medical costs. And just like what we're going to do with Plug Power, I'm going to give you some companies that compete in Humana's space that could actually perform better than them. Now, don't get me wrong, Humana is a very fundamentally strong company. But as demand for medical care increases among older adults, this is driving up costs for this company, and that's why their share price is down. However, they were not the only ones affected by this, because we saw shares of United Health, CVS, Elevance Health, and many others fall in their share price because of this projection. We even saw a Morgan Stanley analyst chime in on this development, saying that Humana offers increased risk now. The analyst also adjusted the profit target of $37 per share for this company if the company were to miss their 2024 results, which could be catastrophic. And if you didn't know, Humana actually moved up their Q4 earnings results from February 5th up to January 25th. So I'm sure investors are at the edge of their seat waiting for this earnings report. But I'm not going to leave you hanging. Let's talk about 3 healthcare stocks that are ready to soar in 2024, with each one better than the last. Starting off with ticker symbol COR. This company's name is Cencor Inc., and they are a pharmaceutical solutions company. And the company essentially is a wholesale distributor of various pharmaceuticals, healthcare products, and solutions. There is a solid bullish case for core stock because many analysts believe they are going to grow their annual revenue by 9.9%, and their full-year EPS will experience an 8.7% increase up to $11.99, and this is why analysts love core. However, I personally am not very impressed with this company, even though they do have a pretty strong fundamentals, as you can see on screen. And due to these fundamentals, that's why analysts have a strong buy rating on this company. But the upside to me is quite minimal. The mean price target for this company is $216.42, while the high-end price target is $242, representing an upside of just 10.65%. But with that expected return, you may be better off investing into the S&P 500 by investing into ticker symbol VOO or SPY. So overall, yes, this is a very fundamentally solid company, and they could do very well in 2024, but the upside is minimal, even though this company will add safety to your portfolio. But let's talk about some better growth healthcare stocks. Next up, we have a McKesson Corporation, ticker symbol MCK. And McKesson is a healthcare services company that offers health information and distributes pharmaceuticals, care management tools, and medical supplies. Many believe that their oncology segment and their biopharma services are their strongest segments, but I think the overall company is pretty decent considering they have a solid growth outlook. They're strategically positioned and they have robust financial results, and I think that this company deserves a spot in your portfolio. But just don't take my word for it. Let's see what analysts say. Analysts rate this company as a strong buying opportunity with 10 strong buys, 1 moderate buy, and 2 hold recommendations. The mean price target for this company is $495.92, while the high-end price target is $563, representing an upside potential of 15.89%. The company is currently trading at $485, so if this high-end price target came true, this company would be up substantially. And I think this company could have phenomenal growth over the year of 2024. So I would love to hear your thoughts on that. Next, let's move on to Cardinal Health Inc., ticker symbol CAH. Cardinal Health Inc. is a healthcare services company that offers bespoke solutions to hospitals, pharmacies, laboratories, physician offices, and healthcare systems. But that's not all. The company also does a lot of other things, such as providing laboratory, pharmaceutical, and medical product solutions. The CEO of the company even highlighted that they have a very impressive capital structure and strategic initiatives as a substantial part of its significant profit growth strategy. And honestly, they are not that bad of a stock, and they have huge upside potential. The company currently trades at just over $100 per share. And here's a side note, if any of these companies seem too expensive to you on a per share basis, go ahead and try to identify a brokerage account which allows you to have or access fractional shares or share slices, so you can invest into these companies for as little as $1. The mean price target for this company is $105.92. However, considering that the company is already trading at $105, all of the future potential could already be baked into this company because, again, this company is more risky than the other two we just talked about. However, if the high-end price target of $126 is true, you could literally get a 20% return on this company, which is very aggressive. However, in my opinion, they all pale in comparison to my favorite healthcare stock, and that is none other than United Health Group, ticker symbol UNH. If you recall from the portfolio that we built from $2,000 up to $100,000, you know that United Health was one of our top 10 stocks that we invested into. This company is a healthcare giant that offers health benefit plans and services, such as care delivery and management, wellness programs, and pharmacy care services. Within the last decade, the company has returned investors over 700% on their money, and that is what has catapulted this company's market cap to $485 billion. And even though this company is already massive, there is still a lot of upside left in this company. But what makes this company so special, and why is their share price so high at $524? Well, I'll tell you. In fiscal 2023, this company reported revenue of $371.6 billion, which is insanity. That would make this company the largest healthcare insurance company in the entire world, giving it a huge competitive advantage. And honestly, I think they're just going to get stronger as time goes on. You should also know that in their Q4 conference call, United Health's management expressed great confidence that the company's, quote, long-term 13 to 16% adjusted earnings per share growth rate will continue from now until 2025. So it's no surprise that 15 experts have buy ratings on this company. One has a hold rating and one has a sell rating over the last 3 months. But overall, this company is a strong buying opportunity according to my personal analysis, and I actually carry this company in my portfolio. But what about Plug Power and the hydrogen market? Well, let's go over 3 hydrogen stocks that I absolutely love, and I personally own 2 of these companies. First, let's start off with Air Products. This company has a ticker symbol of APD, and we actually mentioned them in a previous video. They currently trade at $257 per share, and they are a phenomenal company. They specialize in the production and distribution of industrial gases. And last year, this company took a major step forward to developing the world's largest green hydrogen production facility in Saudi Arabia. And this is going to pay off massively for this company. Air Products is also partnering with a company called AES to develop a $4 billion green hydrogen production facility in Texas. Also, unlike Plug Power, which is a very good hydrogen fuel cell company in their own right, on the other hand, Air Products actually generates massive cash flow, and they do this organically. Therefore, this is a very good stock for risk-averse investors and conservative investors, as they offer investors an attractive 2.7% dividend yield. So not only could there be great growth in this company, but they also offer a pretty good dividend. Next, let's talk about Bloom Energy. This company is a more fair comparison to Plug Power, considering that both of these companies are leading fuel cell manufacturers in regards to hydrogen fuel cell manufacturing. However, these companies do have a pretty large contrast and a void between them because Bloom is already profitable. They have consistently generated a gross profit over the past 5 years, and during this period it averaged an annual gross profit of 16.2%. And this company has just doubled down on their future forecasts, which means the future of this company looks pretty bright. Next, let's talk about Linde. And Linde is very comparable to the other company we talked about, which is Air Products. Linde essentially has committed themselves to advancing the development of the hydrogen economy. And if you're wondering what hydrogen could be used for, it could be used for a plethora of various things. An array of products could be made from hydrogen, including a hydrogen electric vehicle. And if you know me, I think the future of the electric vehicle industry and the automotive industry is actually hydrogen fuel cells. But that is a topic for another video. Right now, let's focus on Linde. Recently, Linde has expressed interest in partnering with Equinor to develop a blue hydrogen production facility over in the Netherlands. But they're also local because they recently expanded their hydrogen production facility over in Alabama. What makes Linde different than a company such as Plug Power is namely their cash flow. Linde is a cash flow machine, generating loads of organic cash flow, which is phenomenal news. So I'm going to leave it up to you to determine which is the best out of these 4 companies when we compare Plug Power, Linde, Bloom Energy, as well as Air Products. And for me personally, I have 2 that really stand out, but I don't want to try to convince you to buy one or the other. Please make sure to do your own research. Next up in technology news, we saw Bank of America predicting that Netflix stock will jump by 22%. So let's dive into it. The Bank of America analyst reiterated their buy rating on this streaming stock, and they upgraded their price target from $525 up to $585. To put this into perspective, their current share price is around $480, so this company clearly has a lot of upside left in it. The analyst believes that Netflix will continue to grow due to their password share crackdowns and the fact that its low-cost advertising subscription plan is receiving a lot of publicity. The analyst said that at the $6.99 price point, the ad-supported tier provides an attractive low-priced option for, quote, borrowers who still wish to access the Netflix service. He goes on to say, in our view, the broader crackdown on password sharing will be an accelerant to Netflix's ad-supported tier, end quote, and I completely agree with this analyst. And the reason why I agree with the analyst is because that's what the data says. Netflix recently disclosed that it now has 23 million active users for their ad-supported tier or subscription, which costs $6.99. This is a very large increase from their original 15 million subscribers in this tier, and it's even a larger larger increase from their original $5 million back in May. So overall, this is very good news for Netflix and Netflix stockholders, and I would love to hear your thoughts down below about this story. And that's going to do it for today's latest news updates. For more videos just like this one, go ahead and annihilate that like button right now. Subscribe if you are new. Go ahead and become a member of this channel for as little as 99 cents per month, because that's what keeps me here on YouTube. And with that being said, I will see you in the next YT video.